Today is the 11th of October 2021. My name is David Hickson, and in today's market update I'm going to be taking a look at the S&P 500. We're going to quickly update ourselves in terms of what's happening there, and then we're going to take a look at Bitcoin, which has been beating with remarkable regularity. Some of the cycles in Bitcoin have been remarkably regular recently, so we're going to be taking a look at that. Before we do take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So to get the ball rolling, we're going to start with the S&P 500. This is an analysis that we've been tracking for many months in the S&P 500, and so you are probably familiar with it. If you are not familiar with this analysis, then I would encourage you to go back and watch the earlier updates in this series, updates for the S&P 500. Of course, we had the very prominent 54-month cycle trough, in my opinion, that formed in March of 2020. And in this analysis, as you will know if you have been watching recent market updates, the big question has been the position of the 18-month cycle trough. You will notice this pin symbol over here, which tells you or reminds me as an analyst working with Sentient Trader that I have influenced this analysis. I have pinned this 18-month cycle trough over here. In other words, I have said to Sentient Trader that I believe the 18-month cycle trough should be positioned at that point, and it has been able to oblige. It isn't always able to oblige me when I pin a trough, and that's because the analysis process is very complicated, and simply pinning a trough in a particular position will not always result in that trough ending up there, but in this case it has. And so we've been discussing this for some time, and of course recently we've been looking at the formation of the 80-day cycle trough, which you can see has again been found and indicated with a pile of diamonds at the foot of the chart. So this is the one analysis that we've been looking at. The other analysis that we've been considering, also for several months I've been showing the other analysis, is what I call the default analysis in Sentient Trader. Let's take a look at that. And I call this the default analysis because I have not influenced it. There is no default analysis that Sentient Trader performs, as I've mentioned in recent market updates. It's simply a default because I've not influenced it in any way. An analysis will change depending on the data that is loaded into Sentient Trader, how much of it is, how much of that data there is, in other words, how far back the data goes, and also, of course, where I tell Sentient Trader to start the analysis, what's called defining the analysis period. I won't spend time discussing that in today's video, but the important point about this analysis is that it indicates that the 18-month cycle trough still lies ahead of us. There is the nest of lows for that 18-month cycle trough. This analysis positions the 40-week cycle trough in early March of this year, which is a questionable position for that cycle trough, as I've discussed in recent market updates. This analysis is looking more and more elegant each time we take a look at it. Of course, an analysis is refined and updated with every new bar of data, but what is particularly elegant about this analysis is the way in which this nest of lows is becoming more and more refined. We're able to narrow in on the exact date of that trough that is expected. And of course, according to this analysis, that is a trough of the 18-month cycle. Now you will find when comparing different analyses in the same instrument that very often, even though you have a different analysis, you still have an expectation of a trough to form at a particular time. In this case, that is expected to be a trough, as I've mentioned, of 18-month magnitude. And you can see how that nest of lows is really becoming very refined. These circles are lining up, you can see, all the way up to the 20-week cycle level. The 40-week and the 18-month cycles are a little displaced off to the right, but nevertheless, that's a very neat nest of lows. That doesn't always mean a better analysis. It simply means that according to this particular analysis, those cycles have been beating with a great deal of regularity. But often it is a sign of a good analysis. And so I have been calling the other analysis my preferred analysis recently, well, for quite a long time now. I have to say my preferences have shifted. That is no longer my preferred analysis. I don't think anymore, but it is definitely an analysis worth keeping an eye on because we've been tracking it for so long. So what is the big difference between these analyses? That's really the important point. So we'll go back to this analysis where I have influenced it, the analysis with the 18-month cycle trough that occurred in the middle of July. And one very useful way of comparing two analyses is to take a look at the Composite Model Line. And I'm going to be looking at a little bit of detail in the Composite Model Line in today's video. We've had many questions about the Composite Model Line. It's a very powerful line, a very interesting line. It's a slightly dangerous line in my opinion. And in fact, this line was developed as a feature in Sentient Trader for a few years before it was actually released because I was worried about the fact that it can be very seductive. And it's seductive because it takes the information from the past and it projects it into the future. And it's very easy to fall into the trap of only looking at the Composite Model Line without actually understanding the analysis. That's why I'm going to spend a little bit of time in today's video discussing how the Composite Model Line is constructed so that you can understand it better. You must not be seduced by the Composite Model Line. When an analysis changes, the Composite Model Line will change. And so you need to be careful of saying, well, the Composite Model Line has changed and therefore that analysis is completely null and void, which is not the case. Anyway, that's getting a little detailed. But the Composite Model Line is a very useful way of comparing analyses and understanding the difference between them. And we can see highlighted here very clearly the difference between these analyses. Well, we'll look at the other analysis in a moment. But in particular, as I have been mentioning in the past few market updates, the Composite Model Line here indicates that, of course, the market is expected to be rising through this period because of the 18-month cycle trough that has been found in the middle of July. You can see that very, very clearly. The Composite Model Line indicates that the market should be rising because of that Composite Model Line, or at least because of the analysis and what the Composite Model Line tells us about the analysis. And in particular, I would like to focus on this 80-day cycle shape that has formed here. Now, I like to identify the M shapes that cycles form in the markets. It's not something that Hurst himself ever identified. It's something that I observed. I have a background in film and television, and I tend to approach things from a fairly visual perspective. And those M shapes are something that jumped out at me when I started working with Hurst cycles. And you will notice the M shape of this 80-day cycle. I've drawn it there. It's a fairly balanced M shape. It's not very bullish. Now, for the first 80-day cycle, following an 18-month cycle trough, you would expect a much more bullish 80-day cycle shape. And when we take a look at Bitcoin, we can compare what's happening in Bitcoin, and we'll see an example of the kind of shape you should see in an 80-day cycle following an 18-month cycle trough. So the Composite Model Line is clearly beginning to be at odds with this, with the price action, indicating that something's not quite right. And perhaps this analysis is not as good as it could be. Let's compare that to the other analysis, which is this one here, and we will display the Composite Model Line. Let's add a few cycles to that Composite Model Line. There we go. I'm going to come back and show you, as I mentioned, how the Composite Model Line is constructed. And so I was just playing around with that before I recorded the video. But here is the very big difference between this Composite Model Line, and you're welcome to pause the video, of course, and go back and compare them. Here's the very big difference. This Composite Model Line is indicating that the market should be generally heading downwards. It's not a very strong move down, and the reason why it's not a very strong move down is because the software has simply not found very much bearish price action yet in the cycle action. Of course, the market needs to come down into this 18-month cycle trough. Okay, that's fairly obvious. The important thing that I wanted to point out here has to do with the shape of the most recent 80-day cycle. I drew the M shape on the other analysis. I'm going to draw it again. It is, of course, exactly the same M shape because both analyses have the 80-day cycle trough over here, which probably now occurred about a week ago, or was it a bit more, about 10 days ago, I think. This is a bar count from that 80-day cycle trough, so about 10 days ago. The important thing here is that the M shape is matching the shape of the composite model line during that period of time. And if we zoom in, you can see it in much more detail. You can see the composite model line is matching really fairly closely what happened in that 80-day cycle, whereas if we go back to the other analysis and zoom in on the same period of time, you will see that the composite model line does not match nearly so closely. You're getting some fairly good sort of price matching up until about this point, but what has happened recently in terms of the price action does not match that composite model line at all well, and the reason for that is because of the difference in the analyses, and therefore it calls into question the position of this 18-month cycle trough in the middle of July. So let's switch back to our default analysis and let's discuss what we are expecting to happen now, and let's display the FLD. Now the FLD, this is the FLD for the 20-day cycle, and you probably know that I have for many years traded the interaction between price and the FLD. Very simple line, the future line of demarcation. It is simply the median price displaced into the future by half of the average wavelength of a particular cycle. And we get a fairly regular sequence of interactions between price and this FLD, and I've been discussing it in all of these videos. An interesting thing happened over the weekend, yet again over the weekend, and that is that price crossed over the FLD. And in fact, to demonstrate that, I should display price as a median line. Let me do that. There we go. So price stumbled across that FLD line, and it ended up crossing the FLD line over there. I think that was actually on Friday. Of course, we interpolate price over the weekend. So the median line has crossed the FLD, which then counts as a price cross. Now you will know that following an 80-day cycle trough, we of course expect what we call an A category interaction, where price should then reach up to its target, and we can take a look at that target, which should be somewhere up here. And so that price cross has not been a very impressive price cross, and in last week's market update video I spoke about the different kinds of price crosses that you get, and how you need to be very careful where price comes up to the FLD but fails to really get across it. And in this case, this is a really good example of price stumbling over that FLD. It's not looking very bullish. Now, why might price not be looking very bullish? Well, the answer is here at the foot of the chart, and that is very simply that price is expected to come down, according to this analysis, into an 18-month cycle trough, which is expected to form in about the middle of December. So if an 18-month cycle trough is expected to form there, of course, one of the things that needs to happen in order for an 18-month cycle trough to form is the price needs to come down into that trough. And so that could give us a clue as to why the price crossing of this FLD has not been very impressive, because there needs to be some bearishness coming into the market, and that might indeed be happening. So if we look at the shape of the 80-day cycle again, there was that 80-day cycle according to this analysis. So what is the shape that we expect for the next 80-day cycle? Well, if this analysis is the correct one, then we would expect a fairly bearish shape with an early peak, and the second peak in the cycle shape should be lower than the first one over here, and we would expect price to come down further. So that is potentially why we are seeing some bearishness come into the market. Now, the sequence of interactions between price and the FLD is very reliable, and we trade them, but you have to consider the other cycles. And if we are now in the final 80-day cycle of the 18-month cycle, this is not really a moment where we're looking for long trading opportunities. We would expect the entire cycle shape to be shifted to the downside, of course. And over the next few weeks, I will take the opportunity to discuss the sequence of interactions and how we trade them in a bearish market, if that's what ends up happening over here. So I mentioned, before I get to speaking about the composite model line, which I'm looking forward to explaining in more detail, let's just quickly compare these analyses again at this kind of time frame. And I've already discussed a few times this middle of December 18-month cycle trough. Let's see what the other analysis shows us. So here is the other analysis with the 18-month cycle trough in the middle of July. Do you notice that we have a rather straggly nest of lows over here for the next 20-week cycle trough? It is not quite as straggly from the 80-day cycle downwards. So if we focus on those cycles and shorter, you can see that we have an expectation for this trough again to form in the middle of December. And so that's yet another reminder of what I call the robust nature of a Hurst cycles approach. Both of these analyses are telling us that the next fairly important trough to focus on is going to occur in about the middle of December. This analysis has it occurring about a week earlier than the other one perhaps, but nevertheless that's when we need to be looking at the next important trough to form. Well, fairly important, 20-week or perhaps 18-month magnitude. And so what's going to happen until then? Well, according to this analysis, of course, with the 18-month cycle trough lying behind us, we would expect to see some bullishness coming into this market. If it doesn't come into this market really quite soon, then we need to be switching our attention onto the other analysis. Now, I mentioned that I wanted to speak a little bit about the construction of the composite model line and how we do that. We've had several questions this week about the potential formation of this 80-day cycle trough. You will know if you watched last week's market update, or perhaps it was the market update from 2 weeks ago, but certainly we were considering this as a possible position for the 80-day cycle trough, or I was, and yet this seems like the more likely position for the 80-day cycle trough to have formed in the markets. And so we've had some questions saying, well, when you've got that sort of uncertainty, what do you do? How do you find some certainty? And one of the things that I like to do is I take a look at the different cycles in the analysis, and I ask myself, which of these cycles has proven to be reliable? So I'm just going to cut to the chase. I'm not going to waste too much time discussing all of the different cycles, and I'm going to point out some fairly good cycles that have been beating with a fairly regular rhythm in this particular market. And so the way that I approach this is I simply measure the distance between fairly obvious cycle troughs. So there we have a 39-day cycle, there we have a 28-day cycle, and not very regular yet, 31 days, and there we certainly have a trough of some importance, 32 days, or perhaps over here at 43 days. So you will probably realize that the cycle that has formed these fairly prominent troughs recently is the 40-day cycle, and we can display that 40-day cycle by means of these cycle lines at the foot of the chart. This is simply another way of presenting the cycle, which is marked by these blue diamonds at the foot of the chart. That's the 40-day cycle, and you can see it's fairly regular, by which I mean that the amplitude has been fairly consistent over this time. The wavelength has been fairly consistent. You can see for yourselves probably that it stretched a little over here, and it of course stretched a little over here. But recently the 40-day cycle has been fairly consistent in this market. It's been beating fairly regularly. So when I find a cycle that has been consistent, I tend to focus on it. And one of the ways in which I can do that is by displaying the cycle lines at the foot of the chart. But a better way of doing it is by simply displaying a composite model line consisting only of that cycle. And that is how we construct the composite model line. Let me show you. So here is the composite model line, which consists only of the 40-day cycle. So it's not really a composite, of course, because it consists of only one cycle. But here is the important thing. This cycle information that you see at the foot of your chart has simply been transposed upwards and placed over the price action. And so we are able to focus on this cycle only. And this is one approach to trading on the basis of a Hurst cycles analysis, is you identify a regular cycle, or one that's been beating with some regularity, and you identify your trading opportunities based purely on that cycle. Although I probably shouldn't say that, because there are very few people who actually do that. You have to consider other cycles. And so what we do is we start adding the other cycles into the mix, and we start considering which of those cycles are going to be useful for us to consider as well. And so the first thing that I tend to do is I step up by one cycle and then down by one cycle. So let's add the 80-day cycle down here to the foot of the chart, and you can see that's been fairly regular. We've got some regular amplitude and some regular wavelengths happening there. And so I add the 80-day cycle into my composite model line. Now, the combination of only those two cycles would have given me this kind of price action that you see over here. And the important points perhaps to notice are that the best troughs, or the most prominent troughs, should have been these troughs over here. These three troughs were the troughs, of course, of the 80-day cycle. But what happened over here? Price didn't really come down. Well, the reason why price didn't come down has to do with another longer cycle, and so I add yet another cycle, and in this case I'm going to add the 20-week cycle, and so we can have a look and see what that would have done to our price action. And that is what happens to our composite model line when we have those three cycles added. Now, let me just remove these cycle lines. I think that, actually, before I remove the cycle lines, I'd like to demonstrate something of interest. And let's just focus in on this price action over here. It's interesting to notice that in terms of the recent price action, we had a comment on, I think it was on last week's YouTube video, to do with the increased amplitude in the shorter cycles. And that was a very interesting and important observation. And so where did that extra amplitude come from? What's actually been happening recently with the price action? And so we take a look at our shorter cycles to understand what has happened. And if we show the 20-day cycle, you can see the amplitude of the 20-day cycle has increased. That is the usefulness of this cycle lines tool. You can see the increasing amplitude of the 20-day cycle. And if we add the 10-day cycle, I think you will see something else quite interesting. And let's turn off the 20-day. You'll see that the 10-day cycle amplitude has also been increasing tremendously. And so that's why we've seen this recent increased volatility, if you like, in the price action, is because of those shorter cycles. That's quite an important point to make. So let me turn off those cycle lines and let's come back to the composite model line, and let's discuss again how we construct the composite model line so that we can work with the cycles that we found to be fairly reliable. So I started with the 40-day cycle as a fairly reliable cycle, added the 80-day, and then the 20-week cycle. Now I like to add a shorter cycle as well, because the 20-day cycle is a very useful one, particularly when we're looking at the 20-day cycle FLD. So you'll notice now that we're getting fairly good price action happening since this 20-week cycle trough. When I say good price action, I mean the price action is matching the composite model line fairly well. But now something interesting is happening. Do you notice this? The composite model line indicated price should have come up to a peak over here, but the price action started slipping away. It started moving down. Why is that? Again, it's because of the influence of longer cycles. And so what I then do is I add yet another cycle, the 40-week cycle. So can you see how the 40-week cycle influence has changed what has happened recently? So this is how you work with the composite model line. This is how you build it. You look at what cycles are actually causing the price action that you are seeing on your in the market. And in this case, and let me just display this drop down here. This is the composite model line drop down. I don't think you can see the title, but you can see I've got cycles from the 20-day, 40-day, 80-day, 20-week and 40-week. Those are the only cycles that are combined to produce this composite model line. This is how I work with the composite model line. considering only these cycles, what am I expecting to happen soon? Now, I'm expecting a peak fairly soon, okay? In fact, it is just possible that peak might have happened. And then, of course, we're expecting the market to step downwards. Why? Well, because this is the analysis with the 18-month cycle trough lying ahead of us. And so, of course, we need to see some bearish price action. So, seeing as we have an 18-month cycle trough lying ahead of us, let's include that 18-month cycle in our composite model line. And there we can see again what the composite model line is telling us in terms of what to expect. So that's how the composite model line is constructed, and importantly, that's how you should work with it, in my opinion, is you find the cycles that have been reliable, and then you build the composite model line using only the cycles that you are actually seeing having an influence on the markets. Of course, as time passes, different cycles come into play, and so it's a constant matter of looking at your analysis and working with your composite model line in order to find the cycles that are proving to be reliable. Now let's take a look at Bitcoin, and this is my analysis in Bitcoin at the moment with the 18-month cycle trough, also in the middle of July. I mentioned when we were looking at the S&P 500 that we would take a look at what should happen following an 80-day cycle trough. And in my opinion, the 80-day cycle trough formed over here in about the third week of September. And you can see we've had a strong price move upwards following that 80-day cycle trough. And it's been stronger than we might originally have expected, but certainly following a very big cycle trough such as the 18-month cycle trough, when you get the shorter cycles forming troughs in the market, you expect the combined action of those cycles to provide you with some bullishness, some upward momentum, which is indeed what seems to be happening here. Now, as I have discussed in previous market updates about Bitcoin, I believe that the better analysis to track is the peak analysis, because in my opinion Bitcoin seems to behave as an instrument that has its cycle synchronized at the peaks. But look at this fantastically regular price action that we're seeing in the troughs. That's why I always keep an eye on both analyses. Particularly when you're working with an instrument where you're not sure whether it is a peak-based or trough-based analysis. And Bitcoin is a medium of exchange, as is any currency. And when you get a medium of exchange, such as a currency, I have observed that sometimes you will see the dominance, if you like, switching from troughs to peaks and back again. And it's quite possible that the troughs are simply beating very well at the moment, very regularly, and the peaks not so well. So what's happening now? Well, of course, we're expecting a 40-day cycle peak to occur, and then we're looking at this 20-week cycle trough to form in the markets. Now, I want to take this opportunity to discuss how a Hurst cycles analysis unfolds day after day and how that price action works. One of the problems with these videos is that I tend to look forward quite a lot of time and will draw out projections and so forth, and then there is little understanding of how we actually update our opinion about what's happening as each day's price action unfolds, and that's a very important aspect of working with Hurst cycles. So what I would like to do is quickly go back to the previous market update video that I made on the 25th of August, and let's take a look at what we were expecting then and see how it played out. So here is a screen grab from that video, which you can see was on the 25th of August. This is at about the 8-minute 45-second mark. And you can see what I was discussing at that point, which was the fact that Bitcoin was expected to form a 20-week cycle peak at about that time. Then it was going to come down into an 80-day cycle trough. And there's the nest of lows for that 80-day cycle trough. I drew an arrow down into it. And that was in about the middle of September. It's a little difficult to see the dates there, but I think that was in about the middle of September we expected that 80-day cycle trough. Then, of course, you can see the composite model line showing us here price was expected to bounce out of the 80-day cycle trough and then drop down further into this 20-week cycle trough over here, which is marked as, I think that's the end of October, beginning of November, perhaps. And then, of course, price would bounce out of that 20-week cycle trough. So the important thing is that when you're working with a Hurst cycles analysis, it's a little bit like driving along a misty road, and you can see as far as the next turn. Then as you make that turn, you get to see the next stretch of road ahead of you. And that's a really important thing. In terms of what we were looking at on the 25th of August, we were expecting price to come down into the 80-day cycle trough. And as a matter of interest, this low for the 20-week cycle trough was at a level of about $40,000, as I think you can see over there. So let's take a look at what happened. Here it is over here, and indeed there is a 20-week cycle peak that formed at that point over there, and then price moved down into an 80-day cycle trough, which you can see was found over here. I've just drawn over the date, but you should be able to see that as the 20th or the week, or the third week of September. Let's say the third week of September over there. And so our expectation was for price to fall out of a 20-week cycle peak into the 80-day cycle trough. And it did that. It fell with more strength, and it fell further than was expected by that analysis. But notice the level that it fell to, which was at a level of about 40,000, which was our expectation back then for the 20-week cycle trough. So what has happened? Well, what seems to have happened is that the bullishness that we would expect from the 18-month cycle trough has begun to kick in. And price came down into the 80-day cycle trough and then bounced out of it. But the bounce out of that 80-day cycle trough picked up extra speed and turned more bullish than we expected at the end of August. So the important thing is that we don't look at our charts at the end of August and then wait until the last week of September and be surprised by that bullishness. Of course, we're updating our analysis each and every day, and we're considering what is happening. And as this bullishness started showing itself, then of course our analysis shifted slightly. But we are still expecting a 20-week cycle trough to form at the end of November. It looks as if that's shifted forward perhaps about a week. And let's just go back to another screenshot, and I'll show you the zigzags that we were looking at that time. So here's another screenshot from that same video at about the 15-minute mark towards the end of the video, and you can see there is the zigzag for the 20-week cycle trough projecting into this green circle. Price level, as I've mentioned, around about $40,000, and here's the time of that trough. Oops, this extends a bit to the right. So that's in about the third week of November. So how does that relate to what's happening now? Well, here we are. We're expecting the 20-week cycle trough still to form at around about that time. But we don't think back to the 25th of August and say, hang on, we should have had it coming down here to the $40,000 level. But instead, we can generate new zigzags, and we can adjust our understanding of what is likely to happen on the basis of those new zigzags. And so here is the new calculation for the 20-week cycle zigzag. Of course, it is expecting price to come down in order to form this 20-week cycle trough. But we don't have very much information in terms of projecting where that trough is likely to form. What do we expect out of this 20-week cycle? We expect an M shape. Already this M shape has proven to be a bullish M shape because it has, of course, rised above its first peak. And so if this is a bullish M shape and remains a bullish M shape, the trough will probably be above this trough over here. And remember, we have to consider more than one cycle at all times. Let's add the 80-day cycle zigzag into the picture. And here you can see we've got zigzag tools projecting in opposite directions. Why? Because we're expecting an 80-day cycle peak at around about the time of this 20-week cycle trough. So how do we work with that? How's this contradiction going to resolve? Well, it will resolve. That's the important thing. It will certainly resolve. So what we do is we focus on what is happening now. I don't want you to fix in your mind the projection that I'm making now for several months ahead. The important thing is to look at what is expected to happen next and take it day by day. And again, the composite model line gives us a good way of understanding what the implications are of the analysis. In particular, we are expecting a 40-day cycle peak around about now. 40 days is not a very big peak, but we will expect a little bit of a move down. This 20-week cycle trough, you can see, has been displaced to the left because of the combination of the bullishness of the longer cycles, indicating we're likely not to get a very big move down. We're going to experience an earlier trough, and then Bitcoin is going to continue to rise. I do hope that you found this market update interesting and useful. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.